Hey everybody, Real Estate Ninja here. I hope you're doing well. We're going to talk about the Federal Reserve. We're going to talk about interest rates. We're going to talk about an inflation metric that's very important we want to pay attention to. It says the Fed's favorite inflation signal dips, which holds near 40-year highs as the savings rate crashed. It says among the Fed's favorite inflation indicators, it has apparently got many and picks and chooses as it pleases is the core PCE deflator. Both the headline and core deflators dropped from September levels, which were plus 6% versus plus 6%, 6.3% prior. And then 5% today, as opposed to 5.2% prior, all right? It says, of course, while this will be greeted with euphoria, peak inflation, we do note that it is still the highest levels since 1983. So the stock market is excited. They are thinking, okay, inflation's coming down, but there's a lot more to it. So let's explain that. Americans' income and spending were both expected to rise once again in October, and they did, with incomes rising 0.8% month over month, which is double the expectations, the biggest jump since October of 2021. Spending also accelerated, rising 0.8% month over month, which was expected. So very interesting. So wages increased the exact same amount as prices did. All right. Now let me stop and explain some things. I'm going to link this story below so you can take a look at it. First off, the slowing down of inflation, I believe, is because of demand destruction. What is happening is people are buying fewer goods because they can't afford all of the goods they could have afforded a couple of years ago, all right? Even though wages are going up, as you can see from these numbers, wages are only going up to stay with prices. And that's only certain prices, all right? That doesn't take into effect everything you buy on an everyday basis, all right? So I want people to understand that. That's very, very important. Another thing that people need to understand is that as wages go up, right? They're going, oh, wages are going up. This is great. Stay up with inflation. There's a point at which the companies that are raising their wages can no longer raise their wages. And the very simple reason you can explain that is, or way to explain it, is that as a company raises its wages, it has higher costs, right? And it is having to raise, which causes it to have to raise its costs of goods even more. And eventually, its customers will no longer be able to buy it, or fewer of them will be able to buy their goods or services. Does that make sense? The whole idea of giving people more money for their wages so that they can go out and buy other expensive inflated goods only hurts your own company because you have to raise the price of your goods or services, which means fewer and fewer people are wanting or able to take advantage of your goods and services, all right? So that is where it gets really, really scary because that means we're coming to an end point, okay? We are seeing deflation start. We've seen it in multiple things, as I explained on my other channel, the Economic Ninja. In January, I said it was gonna start in the spring, and it was gonna start with subscription services like magazines, newspapers, online subscription services. Those are low-hanging fruit, and then they move into other sectors. And now we're seeing the last throes of where deflation's really going to start to take over, okay? And that is where it gets really scary. But unlike what happened in the 2008 real estate bubble, where we saw deflation because people were losing their homes and they were contracting their spending, we now have inflation, inflated goods and services all around the country that we're dealing with. And we're talking about, like it says here, inflated numbers that we haven't seen in the last 40 years. All right, and I still believe that we haven't seen the end of it. So it says down here, finally, against all that, American savings rate plunged to just 2.3% of disposable income. That is the lowest since July of 2005. Excuse me. Now, that is a very important year. And the reason why is because that is when the Federal Reserve had already started its dot plot plan and started raising rates incrementally about 25 basis points every Fed meeting. And they did it for a year and a half, 2 years. By July of 2005, they were just stopping the Fed hikes plan because deflation had started. People had started to contract their spending and they started to dip into their savings. So that is why that is a very, very important date, because that was the peak right there. That's as people had their savings rate was at a certain percentage, their spending was at a certain percentage, and then it started this, and it started to plateau. And it plateaued for a few quarters. If you go look at a Fed funds rate chart, you'll see the Fed funds rate plateaued around that time. And then they had to start dropping it because that's when everything went bad. And that's where we are right now. We are at that plateau and it's just starting to lip over. But what's amazing about this time in history is you have such high interest rates, right? Nominally, when you're adjusted for inflation and adjusted for the cost of homes and things like that, you have inflation like we haven't seen in 40 years. So we have never seen a Fed height raising cycle as steep and as sharp as this is when compared to how short of a time frame it is, coupled with such high inflation. And quite frankly, that gets me super excited because that means the other side of this crash, the down part, is going to be even faster, which means there's going to be even more opportunities. And that's why it's so vitally important that you save your money, you get out of debt, you work on your credit score, you get prepared to buy assets hand over fist. And primarily you want to be buying real estate over any others. And that's not financial advice. I'm a real estate agent, but really I'm a bad real estate agent. I'm a real estate investor. And right now I'm cleared out. My portfolio is zilch, nothing. I mean, I have one house, but you gotta live somewhere, right? And my thing is to be able to buy up as much cash flowing real estate as possible, because on the other end of that, then you start to go buy the other assets, vehicles aren't assets, but the toys, the fun things, going on the vacations. But get your core position in really good, solid cash flowing real estate and you'll be crushing it. All right, guys, I'm going to link this story below. I hope you have a great day. This is a new channel, The Real Estate Ninja. If you wouldn't mind hitting the like button, it helps me out and I appreciate it, guys. With that being said, The Real Estate Ninja is out.